Hello, this is Les Goldstein from Personal Financial Strategies and PFS Wealth Management, welcoming you to our December economic and educational update. First of all, let's talk about the current turmoil in the investment markets. First things first. It's not the loudest or the biggest that persist, but the open-minded, smart, diligent, and flexible who adapt in response to meaningful changes in the world. Capital markets are very complex, forward-looking, always evolving, and constantly changing in today's global system. We are living in an environment of the 5Ds, 5Ds that are depressing long-term economic growth. Below, please find our list of these 5Ds. Number one, debt. The world is pushing the limits of debt at all levels. Debt has grown to such size that debt service payments have started to take away from optimal investment growth. Debt levels are at record highs for corporations, people, central banks, and governments, and continue to grow. D number two, deficits. Governments are continuing to operate with deficit spending and to finance it with more and more borrowing. D number three, demographics. The aging of population is increasing in all developed and many developing and emerging economies, leading to decreases in the number of working adults in proportion to overall population growth. Demand. There is declining demand for goods and services, as well as income inequality, the result of aging demographics and stagnating wage growth. And D number five, disenchantment. Disillusioned populism leads to divisiveness, which leads to political, social, and possibly global turmoil. Now, while it may be more valuable to understand what is happening rather than why it's happening, here's our view on what's going on right now. The current economic cycle has peaked and is beginning to decline. Eventually, this should lead to the realization that the previous average economic cycle growth rates of 3.5% to 4% is now at a lower new normal of 2% to 2.5%. This may mean that the stock market is 25 to 30 to 40% overvalued based on new, lower future growth. Next, the Federal Reserve, our central bank, is raising interest rates back to more normalized levels given our regained economic market stability and the current achieved target inflation of 2%. The Fed is projecting another 0.25%, 1/4% rate hike in December and up to 3 more rate hikes in 2019. This significantly increases the cost of money for everyone borrowing it, especially for short-term borrowers. This immediately and negatively impacts current spending and decreases corporate profit margins as the cost to borrow funds increases. With the U.S. federal government operating at some of the highest deficits in our history, our government will need to borrow even more to finance its current and growing spending, pushing interest rates even higher. The yield curve, which is the chart of interest rates being paid on the safest securities, U.S. Treasury bonds, is partially inverted between 2 and 5 years and is the flattest it has been between the 2 and 10-year period for over 10 years. This stifles growth because it makes long-term lending unattractive. Lenders are simply unwilling to lend for riskier, longer terms at rates of return that are below shorter-term, lower-risk loans. When the 2-year to 10-year yield curve inverts, it is a perfect track record of forecasting a recession or negative economic growth. That is, a shrinking economy within 20 months on average. Next, our trade war with China, a communist-led superpower that is second largest to the U.S. in the world, is not a long-term situation that can be enforced to our benefit. In addition, the UK is scheduled to exit the European Union in March 2019, but has not been able to come up with its own plan or agreement or terms with the EU. Again, Stock markets hate uncertainty. Number 6, strong U.S. employment is leading to higher wage growth. There's more demand for jobs, more demand for workers than there are jobs. This can cause declines in business profit margins down from historically record high levels. Number 7, economic growth has been declining all throughout the world in 2018. The U.S. is the only developed nation that is still growing, the result of recent massive corporate tax cuts as well as some personal tax cuts this year. This one and done effect is over in 2018, and no similar non-U.S. government stimulus is coming to continue to artificially bolster the organic economic growth rate, which has not at all increased from its 2.5% annualized rate, despite any anticipated effects, positive ones, from tax cuts. The U.S. has not decoupled from the rest of the world, and declining economic fundamentals are numerous and growing. Number 8, lower profit margins and declining economic growth has led to second quarter's peak corporate earnings and the beginning of a decline for this economic cycle. While still positive and relatively strong, it is highly likely that 2019 actual earnings will be below currently forecasted 2019 earnings. This may lead to the associated downward repricing of assets, meaning stocks falling, and may follow with a further concurrently unanticipated slowdown in 2019. The Fed increasing interest rates should keep the U.S. dollar strong versus other currencies, making U.S. goods and services more expensive for current foreign purchasers, while the current possibility of a potential decline from current high levels of the U.S. dollar may lead to lower future investment returns for foreign investors, dampening their interest in U.S. securities. Lower demand may lead to declining U.S. gross domestic product. Not to add more fuel to the fire, but the Democrats have taken control of the House of Representatives, leading to a split government and spoiling the president's growth at all cost agenda. Republican-led initiatives and the increasing odds of presidential impeachment, should the shortly upcoming Mueller report provide required evidence, is leading to increased political turmoil and congressional inaction on further economic stimulus through fiscal government spending, including infrastructure and other, as well as any future tax cuts. So, that's the story. Now what? 90% of asset classes in the world are down this year, with U.S. stocks as the single holdout so far. Cash may be the best performing asset of 2018. Correlations, sameness, are at high historic rates, and in the highly synchronized global economy, everything is coming down together. This means that there is nowhere to hide during this seemingly perfectly negative storm. Volatility is still at high historic averages, but sudden volatility spikes have demonstrated the computer-traded nature of markets, where selling causes more selling, liquidity disappears, and there are no buyers. A decade of super low interest rates plus easy lending, fueled by the chase for income, has very likely resulted in a bubble in low quality loans. This may eventually result in much higher than historic 10% default rates once recession becomes evident and credit ceases. Shades of 2008? Not sure. Higher interest rates from the Fed have increased the cost of borrowing and might be the needle that pricks this bubble, dislodging capital markets with spillover effect into all risk investments, including stock, potentially leading to or at least accelerating a recession. Credit spreads for higher risk loans or premium higher interest rates over safer loans have already begun to expand. The U.S. stock market, is illustrated by the S&P 500, has broken its long-term growth trend, and the previous leaders, the technology high flyers such as Facebook, Apple, Amazon, Netflix, and Google FANG stocks, have led the downturn, tumbling the most. So, what to do? When in doubt, scream and shout, run in circles? No, never panic, but always be ready to act. Here is where we are currently. Using the S&P 500 SPY as a proxy for the S&P 500, the stock market peaked way back at about 294 on the SPY. Recently, the SPY is down over 11% from this high. This is larger than the 10% decline that is typically used to define a stock market correction. In addition, we are substantially below the 200-day moving average of this same SPY, the S&P 500 ETF. This fact is commonly used to identify a long-term trend in the index, and that is why we reduce stock market allocations on a client-by-client basis by 25% over the last 30 days. If we decline more than 12% off the peak of this ETF SPY, we will recommend that clients reduce their stock market positions by another 25%, again on a client-by-client basis. In the event that the stock market continues to decline rather than stabilize, once the S&P 500 ETF SPY declines 10% below its 200-day moving average, we will reduce on a case-by-case basis client stock market positions by another 25%. This will leave clients exposure at 25% of their target allocation, 75% below the stable market allocation, thereby substantially reducing risk in each client's stock portfolio, again to be discussed on a case-by-case basis. So to summarize, we recently recommended that clients reduce their stock market allocations by 25%. We will reduce by another 25% if the U.S. stock market does not resume its positive trend and goes lower by more than 12% off its peak. We will stand ready to again reduce stock market positions by another 25% should the U.S. market confirm its downward trend by going 10% below the long-term trend of its 200-day moving average. We have also begun to identify alternative strategies which benefit from increased volatility or market dislocation rather than be dependent solely on overall market direction. These alternative strategies include long-short funds, hedged market neutral funds, and even event-driven positions. We also have begun to increase our allocation to U.S. Treasuries, which serve as safe harbor investments during periods of stock market weakness. We stand ready to employ strategies that protect and profit during cyclical market downturns, including increased cash holdings, short strategies, even gold. Last but not least, we are hoping for a typical end-of-year bounce to materialize in the December to February timeframe. This can happen because private investors can finally estimate their earnings and maximize their contributions to retirement plans, and because professional money managers want to put more money to work in the markets so as to not appear to be charging fees for the large cash balances they might have on hand in search of attractive opportunities. We would use this end-of-year bounce as an opportunity to rebalance even more profitably for our clients while actively managing their risk. These are our thoughts, plans, and actions, and as always, we want to remind you that we don't invest to be right, but to first preserve and protect and grow your wealth. This includes not only striving to adapt to meaningful changes on a timely basis, but more importantly, to make more when we are right and to lose less when we are wrong. It's the tortoise that wins the race. In this case, slow, steady, and the elimination of knee-jerk reactions that may result in poor long-term decisions. It is always easier to deliver good news. Sorry for this report so close to the holiday season, but the truth is always better than a whitewashed lie or story designed to make someone feel better that results in negative outcomes nonetheless. Now, while we believe that the information in this report is reliable, we cannot guarantee its accuracy. Opinions expressed herein are subject to change without notice and are not intended as investment advice or a solicitation for the purchase or sale of any investment security. Please consult with your team here at PFS Wealth Management before making any investment decision. This is Les Goldstein signing off for December 2018. Happy holidays.